Welcome everybody to the Leaders in Housing Counseling call. We're going to jump right in because it's a crowded but valuable agenda, and we've got a lot of ground to cover. Thanks for being on time. It really makes these things run easier. So with that quick note, we're going to just quickly cover what the plan for the call is, and we're going to start getting into the details. So we're going to start out with our federal advocacy funding update from Melody. I'm going to do a quick, it's not on the agenda, but a quick update just on any response we're getting from Fannie Mae on the client management system, HCO term extension, just to give people a quick update of where things are at. We're going to spend a good chunk of time on the lender fee for service issues and RESPA, and with Matt Reeby today from NFCC, who's been doing a lot of leadership on this issue, and be, I think, important to all of us are in the future of being able to find and figure out sustainable funding through lender fee for service payments, and trying to solve some of the problems there. We're going to then, oops, we didn't switch this on the agenda. We're going to jump down to anti-displacement strategies. We have Kevin Stein on the line from California Reinvestment Coalition, doing excellent and leading work on anti-displacement issues. They have a code of conduct which conceptually tries to change the dynamic that happens in many of our neighborhoods. So very interesting stuff. We have sent out the code of conduct with the agenda email that went out this morning, and just a reminder, we also included there the slides from Matt Reeby's presentation, so you have them. You'll find that they're pretty substantial, though they'll be on your screen as well, but you'll have a hard copy that you can refer to as well. And then we're going to spend a few minutes on the HUD Housing Counseling contracts. So just to frame it up, there's been a little bit of correspondence about this, but it's kind of a bumpy year this past year in the HUD housing contract process. We're really not talking about the fact that there's not enough money, and we're not talking about the delays. I think we've communicated that a lot. I think HUD is deeply aware of that, though no problem in communicating it again. But what we're really talking about is the terms of the contract and contracts and how they are actually affecting programmatic decisions that counseling agencies are doing. So if you have some thoughts about this, it's fine to put them into the question box now. We'll try to cover as much ground as we can. The call might go over a little bit over the usual hour, so that we at least touching base on this. And what we're going to do is basically take what people tell us and send it to HUD. And please let me know if you when you write us something, you can email it to me, and that's great. You can put it in the question box. You could do both, which makes my life a little easier. But what we are interested in doing is sending some direct, candid feedback to HUD. We think that they're doing the NOFA right now, or making the decisions around the NOFA for next year, and this is what drives what the contracts will have. So we want to get our input in right now. So it's very timely. I know some groups this has not been such a big issue, and some groups it's been a very big issue, and we're trying to understand with some deeper specificity what those issues are. So to the extent you can give it to us in writing, we'll hit some high points and what others have said, but would love to know what your experience is. If you want us to send your information in, we can either do it just as a direct quote without attributing it to anybody, or we can put your name on it. And it's fine to do either one. HUD will take all of it seriously. They know that we are a process, and we're an organization that would do the appropriate screening. So it's not a problem if you don't want to include your name, but I think there's no risk in including your name and organization as a way of getting recognition for your thoughts. But either way, it's fine. So we'll spend some time on that, and then we'll do a quick NHRC membership plug, and then we'll talk a little bit about the call next in early March, which should be pretty interesting. So with that quick note, let's pivot over to start the agenda. So Melody, tell us what's happening in Congress today and our impact on our work.
Thank you. So as everyone knows, the shutdown is officially over. It's not any stopgap. Fiscal year 2019 is done. We finally get the final numbers on all the different programs of the agencies that are finally funded, including the Housing Counseling Assistance Program at HUD. And for fiscal year 2019, that's going to stand at $50 million. This is a $5 million decrease. Excuse me, a $5 million decrease from fiscal year 2018. Which is a problem. Groups are continuing to have to provide resources to their clients to meet their housing needs, but as we're trying to explain to lawmakers, agencies are working within the parameters of a much smaller and smaller pool of funds every year. And so we understand that while we don't have a current national foreclosure crisis, there's still a lot of housing needs that have to be addressed, and housing counselors are the way to help people. So for fiscal year 2020, which is right around the corner, NHRC and other groups will be asking for $65 million in the upcoming budget. We anticipate that the budget season for 2020 will officially start in early mid-March, when the White House and OMB expect to release their fiscal year 2020 budget proposal, but there's no exact date. We'll be working with groups to encourage their lawmakers to add housing counseling to their programmatic request letters for both the House and Senate Appropriations committees. And every member of Congress is able to submit a programmatic request letter, so we can reach all 530 members of Congress if we all work hard and work together. We'll discuss in more detail our congressional advocacy efforts on our March 7th call. But if you have any questions in advance, please let me know. My email address is mimoh@hsgcenter.org. If you just want to talk about that and see if you want to help in advance. Some good news, though. Representative Kildee will be recirculating a Dear Colleague sometime this year. He was responsible for circulating the Dear Colleague to fund housing counseling last Congress, and we're really, really excited to hear that he'll be doing it again. We'll notify partners when that Dear Colleague is officially released, and once it is, we'll ask different groups to get their lawmakers to sign and join it for this budget season. So that's all I have for right now. We'll go into more detail on our next call, March 7th.
Yeah, and Representative Kildee is from Michigan, from the Flint, Michigan area. This is a relationship that HPF actually developed. Andy Buchek has been on our calls in the past, has done some very good work there, and will be part of the team to help spread this out. Certainly a shout out to Michigan groups in that area. Certainly let him know that you appreciate that. That would be good. Please keep an eye out for emails from Melody, because we are putting together teams of people in different congressional and Senate districts to do direct lobbying and communication. And some of the key ones on the THUD subcommittee are in play now, and if you hear from Melody, please be really responsive and helpful. We've got a terrific conversation going on in California, another one in Missouri. There's several others that we're going to get started in the next couple of weeks that will be helpful to all this. So thanks for everybody's support. There'll be plenty more coming. And
just to add to what Bruce is saying, thank you to the groups that have already reached out, and we're currently working with you on different sign-on letters and researching your districts and states. For the groups that are interested but have concerns about whether or not they're allowed to do advocacy because of their nonprofit status, we'll be going over that in the March 7th call as well. So we'll be able to address any sort of questions or concerns you have about whether or not your group can lobby, and hopefully make groups feel comfortable about doing advocacy with their congressional lawmakers. But we'll also go into more detail about that March 7th.
Yeah, and there are plenty of the groups are already doing this. So this is a tested field, and there's no questions about what you can do. So we'll be helpful on that. Thanks. Okay, thank you so much, Melody. So just a quick, we had a rapid turnaround from the last call on client management systems issues around HCO being terminated in May the end of May of this year, the projected termination, we sent out a letter asking that it be delayed until the end of December. 129 groups signed on, which I thought was really excellent. We know not every group uses HCO, and some had already made their decisions to move on. But it was, I thought it was a very strong showing, and really appreciate how quickly people turned it around. We got that to HCO, and one more try. We got it to Fannie Mae and sent it to their CEO and president and one of the vice presidents who's key in this, as well as Joe Weisbord, who's been on our calls. We also sent it to HUD and to FHFA, which is their regulator. I did get a note this morning from Joe Weisbord simply saying that they're still working on it and will be back in touch when they've been able to do a more fuller evaluation. So it's kind of in the works, but we definitely got this very high on their radar. So thanks for the quick turnaround, and we'll let you know what we know when we know it. So let's move on here to a valuable subject that we've touched on a number of times over the years, and that is the challenge of getting lenders to consistently pay fee-for-service payments for housing counseling services delivered in the origination space. And there's been complications with how lenders view their regulation under RESPA rules. Now that it's being regulated by the Consumer Financial Protection Bureau. We have today Matt Reby from NFCC, National Foundation for Consumer Credit Counseling, and we're going to do a good and I think deep dive quickly into the issues and sort of where they're looking for some solutions. Matt, are you with us?
Yes, Bruce, I'm here. Can you hear me?
Oh, excellent. All right.
Yeah.
So good.
All right. All right. Thank you for the introduction, Bruce. So yes, I'm going to give a quick overview of RESPA and the implications for housing counseling. Bruce did send out earlier this week a comment letter that the Coalition of HUD intermediaries submitted to the CFPB on the no action letter policy. There was some controversy around the broader policy, not necessarily around RESPA, certainly not around our work. So I'll address a bit of that at the end just to get some context for the comments. But if we ask sort of why we're looking at RESPA and lender-funded housing counseling, I think Melody touched on it earlier when she said housing counseling appropriations are down $5 million in the latest Congress. I don't have to remind callers on this call about the timing and reimbursement issues with HUD and how long in many cases agencies have to wait to be reimbursed. So there's timing issues, there's amount of funding issues. So really there's a need to create a sustainable business model with a value-driven fee structure that will support pre-purchase counseling services. Also, as I'm sure callers on this call are well aware, pre-purchase housing counseling is very resource intensive. It's something that, done properly, takes a lot of time. And so there is a need to have a fee structure that supports the amount of work that goes into preparing people adequately for sustainable home ownership. So I think I've covered the topics. I apologize because I can't see the webinar slides in front of me, but I think I've covered the topics on my first few slides. Part of the need for a new funding model, importantly, is not just the agency demand, but it's a question of how to make this work with lenders. And lenders, they might be in a position to provide, relatively modest upfront grants for pre-purchase housing, education, and counseling, but to really scale up the services to the scale that they're needed, and really, I would argue they're needed on a similar scale as we had foreclosure aversion counseling in the response to the crisis. This needs to be a really widespread service. So in order to have enough funding to do that, it needs to be on the basis of outcomes. It needs to be on the basis of actual business closings, not just upfront payment for counseling that may or may not result in people actually buying homes. So if you do have a framework, and we can look at the sort of the business model, the outline of how a business model would work here. You have an optional, I know some housing counseling agencies are not comfortable with, or they don't believe in charging consumers fees up front for services, and that's fine. It's an optional component of a proposed business model that can help with cash flow. It can help with reducing no-shows and increasing sort of client engagement with the process. They feel a little bit invested if they've paid sort of a nominal fee to engage in many cases. But in any event, the main way this proposed business model would work is that lenders would agree with counseling agencies that once a counseling agency has counseled a client and sort of certified that that client is in fact mortgage ready or meets sort of basic criteria to qualify for a mortgage generally, that the lender would make a payment, will make two payments when one of those clients closes a loan with that lender. One would be a credit at closing to the client, and this should be, a relatively substantial amount. It depends on the lender, but something on the order of $500 or $1,000 at closing is completely reasonable. And also a payment to the counseling agency, possibly shared or conducted through an intermediary. So really, these payments would be conditioned upon the closing of a loan, which means that this is all regulated under RESPA. So taking a look at RESPA, the Real Estate Settlements and Procedures Act, there's the Section 8A talks about what's prohibited under RESPA, and really what they're getting at here is kickbacks. They don't want essentially bribes to be taking place for sort of behind the scenes referrals of mortgage business, and this in fact was a subject of major litigation under Director Cordray in the PHH case, which many folks on this call may have heard of. But briefly, what RESPA Section 8A prohibits is giving and receiving of a thing of value in return for the referral of settlement services. So thing of value, of course, money or things of value. Referral is any action intended to affirmatively influence a consumer selection of a particular settlement service provider. So that's a pretty broad framing. Anything that affirmatively influences, that's really intended to capture just a wide variety of activities. And then again, there's several things listed there under settlement services. You'll see, this is quite sort of a long list to include on a PowerPoint slide maybe, but what I would point to here is you've got very specific enumerated services, real estate brokerage services, title insurance, homeownership insurance, etc. But what is not included on that list is counseling, right? So because counseling is not specifically included as something that's regulated, there's this question, this ambiguity out there of how does the law treat counseling and payment for counseling. So if we look at the exemptions to RESPA, Section 8C contains the exemptions. And 8C2 says you can make payments for services actually provided. And again, there's a question of whether counseling counts as one of these services. But the payments must be commensurate with, or they must be around the fair market value of the goods or services. If the payment substantially exceeds the value or the fair market value for the services, that can be considered a kickback. So, say I'm doing home inspections and the value of an inspection is $500, but I'm paying my inspector $1,500, that $1,000 difference could be considered a kickback as sort of a sweetening the pot, which would be an illegal inducement for a referral under RESPA. So the regulators have not provided meaningful guidance on whether pre-purchase counseling is a bona fide service within the meaning of RESPA, or if it is, how to determine what the fair market value of a service like counseling is. So we have been working, and Bruce and others have been engaged for quite a while with the CFPB on efforts to gain some clarity around RESPA. And to date, they've issued some sort of verbal guidance, but it hasn't really been enough to really provide a strong signal to the marketplace. So if we're looking at specifically what we're asking for the regulators, in this case the CFPB, to clarify about RESPA, it is to provide some clarity on exactly these elements that I've described. The first is that we are talking about making a referral. So if you're a counseling agency and you have a list, even if it's a relatively long list of participating lenders and lenders that you're working with, you are affirmatively influencing the client selection of a lender. So we are talking about referrals here. The question is whether the payment for that referral, whether the payment is for the services provided rather than paying for the referral. So again, that depends on the value of the counseling services provided. And today, there's not a clear and consistent and reliable framework for determining what the value of the counseling service is. What we are arguing is that the value should be calculated according to the value the lender receives rather than the cost of providing the counseling services. So if you think about it, and I'm sure this is something that callers here understand and sort of believe in their bones, but counseling is quite a valuable service, not only to the client, but also to the lender. If you think about the ways that a lender might receive value from counseling or having their clients, their borrowers, be counseled, obviously counseled clients perform better. We know this. They're less likely to default in the future. But there's sort of a variety of other ways that counseling is valuable. If someone has been working with a counseling agency and is certified sort of mortgage ready, they're more likely to complete underwriting. They're not likely to fall out during the process. This is somebody who's actually ready, who's in the market, whose finances are prepared, and in many cases, whose documents might even be prepared. So there's some value there. And so what we're going to be asking the Bureau to do is just affirm this value calculation. So as I mentioned at the outset, the Coalition of HUD Intermediaries submitted a comment letter in favor of proposed changes to the Bureau's no action letter policy. The no action letter policy was actually something that was put in place under Director Cordray, but to date has not been as successful as many would have hoped. In fact, the Bureau has issued one single no action letter so far. And in fact, I can say from our discussions, NFCC's discussions with lenders over fee-for-service pre-purchase counseling, there hasn't been a whole lot of interest in applying for a letter under the current policy. And really a large part of that is due to the fact that no action letters today are not binding on the CFPB. Basically, a no action letter is the Bureau saying, okay, we understand that this question or this service that somebody wants to provide poses some novel questions, and so we're going to state our interpretation of what the regulations are, what they say, and how those regulations implicate the service that you want to do. And we will not take any enforcement action based off of this understanding, so long as you adhere to this understanding. But because that letter is not binding on the Bureau, it doesn't actually provide real tangible relief, or at least many lenders don't consider that it does. So what the proposed policy would do, amongst other things, is it would make the letters binding on the Bureau, at least for a prescribed period of time, which would really strengthen the assurance signal that the letters are intended to provide. The Bureau opened formally announced this proposed policy change in December and opened the comment period in December. It recently closed. The comment period did on February 11th, and so the Bureau the coalition submitted comments to the Bureau in favor of the proposed policy. We argued that stronger assurances are needed for the reasons I've just outlined, but we cautioned against a broader application of the letters, which could undermine existing consumer protections. And this is an issue that has been raised by a number of consumer protection groups, as well as a number of state attorneys general who have concerns over sort of the broad framing of the proposed policy. Because what the Bureau did in their proposed policy was not just propose to make the letters binding, but in fact argued that the scope of them would be not just to clarify existing regulations or to provide an interpretation of an existing regulation, but also to provide exemptions from existing regulations, and not just federal regulations, but perhaps state regulations as well. So there's a number of sort of administrative law, regulatory questions about the scope of the proposed policy. And we were very clear in our letter that we thought that would be an inappropriate use of the policy, and to be sure, there are a number of groups out there very focused on this issue. However, really, with the past several years being sort of an indication of why this change was needed, as I mentioned, and I know longtime participants in these leaders' calls will know that Bruce and others have been very engaged in trying to get regulatory clarification on RESPA issues, and it frankly has not been forthcoming. And the official process, what's called notice and comment rulemaking, can take a long time. It requires a lot of political capital, and it's just not something that we can expect to happen anytime soon, where a proposed no action letter covering this framework is something that's in fact quite realistic, and that I've been speaking with Bureau staff about. So I hope that is clear, the overview of sort of RESPA and how the business model would work. But I'm happy to take any questions that Bruce, you, or callers might have.
You have two questions that
Okay.
people submitted. If I can just pull them up, if you can give me a moment.
Okay, so I'll jump in quickly just with a couple quick comments. So this was
Sure.
an excellent overview. I love the detail here, and it is a complicated area, and Matt has done a good job about sorting it out. So one thing, which is a question I think that people have, is will lenders be willing to do fee-for-service payment currently? And the reality is some are doing it now, and we expect will continue to do it. Others have hesitated, and because it's not clear whether there might be RESPA violations to them and their legal team, there's been a number of there's been one particularly big proposal, and probably some others that have been held up and maybe stopped by this lack of clarity, and this is what we're trying to get at. But it doesn't. You shouldn't feel like you should ask for that when you're talking with individual lenders. It's still doable in the eyes of some banks, just not all of them, or lenders, excuse me. The other thing, I just thought we should just recognize that this was a tricky problem, that there were in front of the CFPB, this proposal for a no action letter that Matt talked about was a way of basically eliminating very substantial consumer protections in areas, and they were going to create what's called a sandbox where you could do things without worrying about regulatory intervention. And that was seen as a real red flag for a number of the groups that are the consumer-oriented groups. And what I think really the coalition letter, and Matt was the one who wrote it, does a very good job about trying to define this much more narrowly and say that these rules should be used not to eliminate or reduce consumer protections, but to provide clarity where there's not clear guidelines currently. So kind of walking the tightrope between getting some greater flexibility that we need in our field without selling our souls around critical consumer issues. It's a difficult issue, and I know lots of people struggled with this. So, Melody, we got questions in place?
Sure. Matt, first question. Are lender-paid incentives considered as program income for the purpose of HUD billing?
Yes, I believe so.
Okay. That was fast. Second question is, who determines the fair market value per state?
Per state. You know, what we're working on now is a comprehensive framework for lender value nationwide. I'd be curious to look more at sort of state level. I can see there being fluctuations in the state level value, but really what we're asking for is a blessing of the concept, and then we can look at how it might vary from state to state.
Can you say anything more about how you get to a value on the value to the lender? It's an interesting concept. I hadn't heard of it. Yeah.
Mm-hmm. Yeah. No. So it's something I'm working on now with someone we don't let out very much, who knows a lot more about mortgage origination than I do. But it's essentially it's a broad framework. So I mean, if you think about, lenders have sort of an acquisition cost formula that they use on average, and you know, it may surprise you some of the numbers that get thrown around, but you know, the marketing acquisition costs that some lenders pay to close a loan can be on the order of $2,500 or $3,000 per person who closes, and you know, that's because you know the search terms are expensive. You know, you get a lot of leads that don't pan out, and all of that. So we're looking at creating, you know, not a formula that will say, you know, what is the value of John Doe, you know, this individual person who got this individual mortgage loan, but this is a you know, a framework for determining the value on average, and then you can parse that out by different sort of, you know, loan types or loan amounts and things like that. But really, it's an overarching sort of formula that we're deriving.
Sounds exciting. Well, I'd love to hear more as you develop it. That sounds great. Well, I think thank you very much, Matt. This was terrific. And
sorry, we have just one more question for Matt.
Okay.
Is there an implication of the arrangement that housing counseling agencies would only refer to partners who pay them, or else lose a lot of money? If so, how is that not paying for a referral?
So it's a good question. It's not paying for a referral, again, if the payment is commensurate with the value of the services. But of course, you know, the broader question is a good one in terms of, you know, how does this fit with the work that we do as housing counseling agencies? And of course, you know, first and foremost, you should be sure that, you know, the lenders that you're working with are providing good loans, right? That the terms are competitive and reasonable, and that there's no, you know, hidden fees, or, you know, that you're not signing somebody up for an interest-only subprime loan, etc. So that remains paramount and important. So the actual products that you're getting people to sign up for. In addition, you do still want to make sure that you are, one, informing the clients of multiple lenders, even if there are multiple participating lenders. You also may want to consider whether you advise them of non-participating lenders as well.
Okay, last one. Will there be any collaborative marketing campaign around fee-for-service model for nonprofits to help change the perception of how we are funded?
Mm-hmm. You know, that's a very good question, and certainly, you know, we're doing some pilot work around this. Marketing and messaging and promoting all of these services, not only is it expensive, but it's difficult. Getting the messages right, getting them attractive and in ways that people will respond to is very tough. So I'd certainly be happy to work with anyone who wants to collaborate on a broader marketing push.
Great.
Okay, great.
Thanks so much. Thanks so much, Matt. So let's move quickly on to Kevin Stein from the California Reinvestment Coalition. They're doing important work on anti-displacement issues, and they've now got a anti-displacement code of conduct. Kevin, are you with us?
I am with you.
Excellent.
Yeah.
I know you're driving, but thank you for doing this.
No, my pleasure. And actually, I thanks to the last two questions because it enabled me to get to my destination. So I'm no longer driving, and which is good, but maybe then no excuse for a disjointed presentation. But I'll do my best. Thanks for having me, Bruce. And it's great to be talking to the counseling agencies. We at CRC, we have a number of our member organizations that provide housing counseling, and maybe some of them are on the phone. And I was going to say, I know how hard you all work. I don't think I know exactly how hard you all work, but I really appreciate the work you all do. And I really do think that, especially during the foreclosure crisis, I know the folks in California with our homeowner bill of rights, but also nationally, made such a huge difference, not only in terms of helping families one by one and adding up to many, but really kind of educating everybody about what the issues were so that to the extent possible, we could try and fix some of the problems. And I think it made a tremendous difference. So, yes, so I'm at the California Reinvestment Coalition. We're an advocacy coalition. We're statewide. We have 300 nonprofit members. We're really trying to get financial institutions primarily to invest in low-income neighborhoods and neighborhoods of color in our state and to stop engaging in predatory financial practices. Right now, we have a few big campaigns. One of them is to protect the CRA, the Community Reinvestment Act, and I know some of you have been involved in that. Really important, and hopefully when folks, CRC or NCRC or Bruce comes back to you for support, you guys will help us out, because if you care about home ownership, CRA is critical. We have another campaign called Here to Stay, which is about creating access for immigrant families to the financial mainstream in different ways, and we're trying to do that in a way where we have the voices of immigrant communities that are kind of leading the way. My colleague Sarah is working on that. And then we have this campaign around anti-displacement, and more specifically, really trying to, I'm right now in Silicon Valley, so we're trying to disrupt the financing of displacement, recognizing that there's just a lot of incredible work being done to fight displacement and foreclosure and small businesses having to leave and community institutions shutting down and nonprofits not being able to stay. And so we're kind of tackling this one piece of it, which is the financing that enables, in our view, displacement to occur. And just to give some sense of how we got here, a few things came together a few years ago for us. One, talking about the foreclosure crisis, what was happening to all the homes that were foreclosed upon. And, as I say, we're statewide. We have folks throughout California. And in various communities, people were really alarmed by the extent to which cash investors and Wall Street investors were buying these properties. We did a report on this dynamic a few years ago where we surveyed our members, and you would not, and folks like yourselves who have seen this firsthand. And the upshot of it was that people were very clear that this dynamic was not only depriving first-time homebuyers of the opportunity to buy homes, but it was a bad deal for tenants because they were getting new landlords who were bad landlords, and it was bad for communities because the communities were changing so much. And that kind of led to, in doing that report, we noted that Fannie Mae and Freddie Mac were financing this REO to rental debacle, and that some of the banks that people know and love or hate were also financing in a similar way as the subprime, as folks may know, so that the rental streams for this from REO to rental were securitized. And at the heart of it were some, billion-dollar loans from a J.P. Morgan Chase or a Wells Fargo. So we started to do some advocacy there, including with FHFA. I think maybe some of you may have signed on to a letter we did not too long ago, maybe about a year ago, to FHFA saying, we're concerned about anti-displacement policies that are flowing from the efforts of Fannie Mae, Freddie Mac, and the Federal Home Loan Bank, namely still financing REO to rental at that time, but there's been some success there, that in buying mortgages, an increasing share of the mortgages that the GSEs considered part of their affordable home loans were going to upper income borrowers in low income neighborhoods. And the Federal Home Loan Bank, not to be left out, was allowing membership of real estate investment trusts, some of whom were engaged in some of these bad practices. Then, happening at the same time, we happen to be going through a strategic planning process, talking to a large number of our members. People are saying, yes, displacement is huge. It's huge in LA, it's huge in the Bay Area, but it's huge in many communities throughout the state. CRC should do something about it. And then this was kind of the kicker, and apologies if some have heard me tell the story, which is a little bit old, but it kind of paints a picture of what we're dealing with. And this was a few years ago when a number of housing groups in San Francisco came to us and asked if we had any dealings, since we're the bank group, if we had any dealings with First Republic Bank. And they were asking because First Republic Bank at that time, they figured, seemed to be the lender of choice for speculators that were buying rent-controlled buildings in San Francisco and then kicking out all of the tenants through some, kind of loophole in our state law, and then selling the properties for condominiums, for luxury condominiums. So the hardship to the families, loss of affordable housing stock to the community, and then if that wasn't bad enough, they were seeking CR, Community Reinvestment Act credit, because they were saying, look, we made loans in low-income neighborhoods and we should get some credit for that. So we did engage in a campaign there. We tried to talk with them a couple times. Nothing happened. We protested in front of their branch, and then we agreed to what we thought was a good resolution at the time, where they took certain steps to enhance their due diligence so they wouldn't make what we were labeling displacement mortgages. And they agreed to help finance some nonprofits to buy some of these smaller buildings where people, what's referred to these days as naturally occurring affordable housing, whether it was rent controlled or it just happened to be at rates that people could afford to live. And so these are, these units are so important to the community. Fast forward to last year, where we decided to take this framework and look more deeply at one city, which was the city of Oakland. We teamed up with a great data and mapping organization called the Anti-Eviction Mapping Project, which may be in multiple states. And we talked to a large number of groups in Oakland. Who are the bad actors here? Because displacement is clearly happening and has been in Oakland. Who's responsible? Who are the bad landlords? And when we looked at who they were, we then looked at where they got their financing. And there were a large number of banks that were financing these transactions where we thought the banks should know or have known that these were bad actors, and that a likely result was that the lower income folks that were living in these properties were going to get evicted, because some of the landlords had this as practically an explicit business model. Some of our allies refer to the relationship between the landlords, the speculators, and the banks as a co-conspiratorial relationship, that they both knew what the scheme was and they were both involved in fueling it, and both should be held accountable. So we're trying to hold the banks and other financial institutions accountable for this dynamic. When we looked at who were the lenders to the bad actors in Oakland, lo and behold, who came out as by far the worst offender? It was First Republic Bank again. So we have been engaged in this campaign with First Republic Bank, where we protested in front of their branch again, and We continue to advocate in different ways for them to do better. And what does it mean to do better? So Bruce alluded to or mentioned that we developed a short, simple, somewhat simple code of conduct, anti-displacement code of conduct. And this was an answer to the question of, well, what do we want institutions to do? There's been a lot of enthusiasm for the code of conduct because I guess it's simple, because it resonates for people, because it hits a nerve with so much concern around displacement. We've asked them, we really focused first in Oakland and then in California. We asked groups to endorse the principles in the code of conduct by essentially signing on. And on the last page, so it's like a 2.5-page document, 3-page document. The last page are just the groups that have signed on. And I invite any of you who have the time to look at it, especially if you're seeing these issues in your community. I appreciate any feedback people have about what we've laid out there. And if you feel good about what's written there and want to sign on, that would be excellent too, because we think the more groups that sign on, the more momentum we can build for institutions to ultimately sign on, which is the goal. One cool dynamic with regard to the code of conduct was that in hearing us present about it at a conference, one of the large foundations, I think in the country, the Silicon Valley Community Foundation, was starting to think, well, hey, we give a lot of grant money to groups to fight displacement and keep people in their homes, but what are we doing with all the money that we kind of invest, that we sit on in a way? Are we funding, is it sitting in banks that are financing displacement? And so we had conversations with them. They ultimately not only signed the code of conduct, but they engaged a smaller, kind of good-minded community development financial institution bank called, the smaller bank out here, Community Bank of the Bay. So they kind of like did the work for us. The foundation negotiated for Community Bank of the Bay to sign on to our code of conduct. I could say a little bit more about First Republic. Maybe I won't, and maybe I'll leave with two kind of further thoughts in terms of what else might be in store or could be in store for the code of conduct. We think it's a good framing of the issues and a good way to start a conversation with socially responsible investors, a few of whom, so in a way, that's the Silicon Valley Community Foundation was approaching this as a socially responsible investor. We've had conversations with others who are interested in it, and we're really thinking about it in two other contexts. One is the opportunity zone context, which I imagine many of you are familiar with and people may have different opinions about. From our standpoint, we're very much concerned that opportunity zones are just going to be a way to pour fuel on the fire of gentrification pressures in certain communities. I know this is not the case for every low-income census tract throughout the country, but for many of those in California, and many of our members, I think, believe this as well. We're really concerned because there's just potentially, as people know, billions of dollars to be invested in low-income neighborhoods with pretty much no parameters that would restrict, or guardrails, as they say, restrict what kinds of investment are okay, and certainly nothing that says, you can't finance displacement. So we're wondering, can the code of conduct be a way to help maybe local land use decision making with regard to opportunity zone investments, or could it be relevant for state legislation that would tag along with opportunity zones in particular ways? And then the final maybe thought I'll share before I stop is tying it back to Community Reinvestment Act. So right now, as I mentioned with the First Republic example, there are definite loopholes and blind spots in CRA. That First Republic Bank could get CRA credit for making a loan to a speculator where everyone kind of knew that low-income people were going to get kicked out and that those affordable, quote-unquote, affordable units would become luxury condominiums. That's a problem with CRA. It's a problem with First Republic. It's also a problem with CRA. there are definite things to fix, but for the most part, CRA is so important and so critical and is under such tremendous threat right now. So while we are trying to stave off efforts to seriously weaken the CRA by a regulator who, is not a fan of the CRA, we're also trying to say there are ways that it should be strengthened. And one of them is to say, if a bank is, the idea of CRA is banks are supposed to help meet community credit needs, including low-income communities. That's, for me, that's the essence of CRA. And that's why banks work on first-time homebuyer programs and portfolio products and work with housing counseling agencies. And what we see with the financing displacement is banks harming community credit needs. People who get evicted are not going to be able to find another place to live. They're not going to be able to save for home ownership. So we think there should be downgrades for banks that engage in displacement financing or other harmful acts. And maybe with that, I will leave it. And if people have questions, great. And if they don't, that's fine too. And I've got 10 minutes to spend with you. So thanks so much.
Just excellent. Thank you so much for all the good work, Kevin, and great presentation. Just a reminder to people, we're going to go over the hour so we can have some conversation about the HUD contracting, and we'll have Simone Griffin from Home for USA. She's got some good insights on all this, but very interested in hearing from people. So please stick around for another 10 minutes or so after the call, after the hour, so that we can make sure we cover that as well. So Melody, got some questions in the loop?
Thank you for your presentation, Kevin. We have one question come in. It's a bit lengthy. With the constant rise in housing prices, yet wages are remaining stagnant or flat, how do we further push or mandate financial institutions and lenders to adhere to CRA's lending tests and increase affordable housing options for LMI borrowers by both track and income throughout the country?
That's a good question. It's kind of a big question. It's kind of like what we try and do every day at CRC and at other organizations. I think, I guess it brings me back to where we are right now. So yes, housing prices. I guess you've probably all been to many conferences and you probably have better ideas than I do about what we need to create more affordable housing opportunities. We need more supply. I'm always hesitant when people talk about removing regulations to make it easier to do things like build, especially with these kind of countervailing displacement concerns. But there's a lot that can be done, and yet it's all challenging right now. But if we're thinking about the role of financial institutions, then I think about what, from our standpoint, generally, I know you all have good relationships with people at banks, and that's great, and it's important. I think they're only doing what they need to do. Maybe not the people maybe the people that you all work with and have good relationships with, that's what they're about. They want to help the community. But they're only hired by institutions that feel like they have to do a certain amount. And right now, I guess I'm thinking in response to the question that CRA is a further challenge to all the other challenges you're aware of to getting people into home ownership, because the message has been sent to banks that they don't have to care as much as they did before about their participation in funding affordable housing, home ownership for low and moderate income people. And I think that's because of the election. That's because who's in charge of the agencies now. That's because of the administration. And what do you do about that? It's advocacy. It's to fight back. So we got to fight back on CRA and say, for example, like this is a somewhat obscure thing, but I couldn't believe it, and yet I could believe it. So we have a lot of problems with the current head of the OCC, who ran a bank that we have formally accused of redlining. We filed a redlining complaint against One West Bank for not lending to African Americans. There's a lot to be said about him, but this wasn't even his fault. Before him, there was another guy who wasn't so great either. And under his leadership, the OCC passed a guidance that some saw, but probably not most people, that said, as we're regulating, the OCC regulates the national banks, the ones that are, the Chase, B of A, Wells, Union Bank, US Bank. And they said that even when there is evidence of discrimination, that this would not necessarily affect a bank's CRA evaluation. So the CRA evaluation is like, how well are you serving the community, including low income and moderate income communities? For things like home ownership, like the HMDA data, the home lending that banks do is a key part of most banks' CRA evaluation. And here you have the regulator for the national bank saying, even if there is evidence, not that like CRC alleges, but we accept that there is evidence of discrimination by a bank that we regulate, it won't necessarily result in the bank getting a worse grading for its performance in serving the community. I mean, that's outrageous. So I think right now is a time to fight, in this arena as in most arenas. There are a lot of positive things happening. Like, I know a lot of people we have obviously, same in many places, but we have this big affordable housing crisis in the Bay Area. People are coming together across, different stakeholders to try and find solutions that everyone can agree to. So good things are happening, but there's a lot of bad things happening, and it's a time to fight. And the one thing that I think about the counselors a lot during the foreclosure crisis, because I know that people were working so hard trying to help a family or 10 families or 100 families. And that should be enough. That's more than enough. But in a way, for the larger good, it wasn't enough. And we needed the counseling agencies to advocate. And I know for some, that was not intuitive. Maybe for the leaders on this call, that is. But I think to the extent you all can be engaged in kind of pushing the issues and fighting in different ways, and CRA defense would be an important one, and protest bank mergers, or ask banks, try and hold banks accountable if they're not doing what you think they should be doing. Send a letter to the regulator, talk to the media, talk to NCRC. We're part of NCRC and I'm on the board. So yeah, I guess I don't know if that's helpful or not, but I think that's what I would think how I would think to respond and what I would suggest.
A good call to action. Thank you so much. And thanks for joining us. We'll want to hear how this is going, and maybe sometime in the next 6 months or so, it'd be good to get an update of how well this code of conduct is working and your broader strategy on anti-displacement. So thank you very much, Bruce. Kevin.
Thank you. Thanks to everybody. Take care.
Good. Okay, everybody hang tight. Let's not drop off yet, because we have one more important topic, and that's we have just gone through kind of a painful year of trying to do the HUD housing counseling contracts with HUD, and we're at a moment where we have the ability to impact what next year's will look like. We think that HUD is probably working on designing the NOFA for the upcoming year, and it's in our interest right now to say these things worked well and these things did not work well, and why there are specific problems for our individual programs. And I'm really talking here about the contract details. I know that there wasn't enough money in the contracts, which is really a problem with Congress, not with HUD. And we know that these things were painfully delayed, and that was deeply problematic, and no problem with saying that. But we also want to think about what are the specific requirements around in the NOFA and in the contracting that impact our work that we'd want to see differently this year coming up, which we hope we'll see the NOFA in the next month or two. So with that note, Simone Griffin from Home Free USA. Home Free has been doing some very good work in this field. A number of you have written me, and thank you so much for that. But Simone and her team have been out front on this issue, and we wanted to hear from her. Simone, are you with us?
I am. Can you hear me?
Oh, perfectly. Thank you.
Great, great.
So give us your broad view here.
Yeah, so we went in and we had a really great meeting with Sarah Jarique, Joe Grumley, and a few others. Joe is on Brian Montgomery's team, and just a few others in the HUD environment. This was in December, and quite frankly, we expressed significant dismay with the entire process. While we recognize some of it was out of their hands, there was a lot that was within the control, and I'm not going to say control of OHC. I'll just say in HUD's control. So I got the sense that OHC did the very best they could with what they had, with the options that they had, but it still created a terrible experience, and it delayed funding from the money. Once the money finally came down, it still delayed funding from going out. So after speaking to the intermediaries and Home for USA affiliates, we submitted a couple of suggestions to Sarah and Joe, and so FHA, the FHA side has it, and all of that, and certainly one was the 2-year NOFA, which I think they have agreed that would be allowable. But the other things, just really quickly, I think we only gave them about 5 or 6. Of course, get funding out earlier. That's really important. And what we found was that the reason that the funding, even though the award came down in July, HUD had so many changes. HUD senior management had so many changes to the execution of the grant. That is why we saw so many differences this year. So, but that's a problem for us, because our point is, it's from what I gathered from our affiliates and ourselves, it's not so much that there are changes, it's that the changes were not communicated early. And when we say early, we mean before the NOFA came out, when the NOFA came out, at what point were they communicating with us, hey guys, we want you to know that we've got a lot of changes that are coming out in the 2018 NOFA. So, and on top of it being late, it was different. The scoring criteria was different. So we asked, the biggest thing we asked for was earlier communication, more consistent communication, and communication from one source. I don't know if you guys experienced this, but we got one word from, let's say if HUD would do a webinar, and then we would get a different word if Booth Financial did a webinar, and then we got a different word if our POC talked to us. And they weren't necessarily conflicting. It seemed like they were evolving. But this is the kind of stuff that they needed to know in advance of putting a NOFA out, especially when the NOFA is coming out after the end of the fiscal year. And all of those changes became a major problem for our agencies, at least, because they were already prepared as to what they were going to bill based on previous years. And so they had already done that. They had already settled it in their accounting systems and all of that, only for HUD to come and say, okay, this is no longer acceptable. And one of our biggest issues was that one of our agencies is a phone, they do counseling primarily via phone, and we use this as an example. They do primary phone counseling. Well, HUD said phone is no longer allowed. They were fortunate in that they were large enough to have a micro rate, NICRA, I think, rate, so they could bill under the indirect cost. But if they were not so large, they would not have been able to do that. And even that costs time and money for them to go back and restructure how they're going to complete their billing. For most of our agencies, and I can't speak for everybody on the phone, but most of our agencies are not as large as that particular one was. And again, that agency had to take a lot of time and resources to go back and fix things. So we brought that up to HUD as well. And I'm going through just seeing, again, the turnaround time, that was another thing we brought up to them. The turnaround time was far too tight between the time that the NOFA was released and the time that it was due. So we suggested that either notify the intermediaries when we can expect for the application to be released, or give us more time to complete. Obviously, we'd just like to know so we can prepare our timeframes a little bit more accordingly. So, and then we had a couple other things about rent and other indirect. We also suggested that consider rent and other indirect expenses only as a percentage based on the budget of the entire agency. So, for example, if the HUD budget accounts for 10% of total operational budget, only allow up to 10% of total rent billed to the grant. The reason that we came up with this is because Sarah indicated to us that senior HUD officials were mostly concerned about making sure that funds for housing counseling go direct to housing counseling, which we can support, but there are obviously, you can't do housing counseling on the street. So we need a building to support this work. So we support that, but there are ways to streamline the cost and the budget allocation to ensure that the money is going to support housing counseling. So that is, I'm giving you really broad synopsis because I know we're already over, but I just wanted to give you a sense of what we have already promoted to HUD, what we've already put out there. I can tell you the final thing is that one big issue is that OHC is doing things at the requirement of senior HUD officials and possibly Congress, but mostly senior HUD officials. So a lot of our advocacy is probably going to have to be switched up to, we've been really advocating on funding, which we have to continue doing, but we're probably also going to have to add why it's important to allow funding, our billing to go a certain way. That's probably going to be another element of our advocacy beyond just talking to OHC, because once it gets down to OHC, the only thing they can do is implement. And they don't have the power, quite frankly, to encourage senior officials the way that we do to make some changes in a way that we know will support the community in providing housing counseling. So I'll wrap there.
So that was excellent, Simone. Thanks for all the good work here and the good summary. I think one of the issues that I've been hearing a lot about is that indirect cost rate doesn't apply to organizations that have branches or affiliates that it may not cover appropriately the costs of those branches or affiliates. That the indirect cost rate applies to the headquarters, but not to the more outlying branches. I mean, and there's a lot of complexity to all this. And what we're trying to do is really we're not going to try to summarize all this. I think what we're going to do is take what people tell us and just send it as a summary document with direct quotes from what people are saying so that we give them the kind of the raw data.
Absolutely, absolutely, and I think we definitely need to do that. And I do think, Bruce, that we're going to need to push this up with OHC support. Push this beyond them, because from what I'm gathering, these are people as part of the new administration that are really coming in, and their focus, and I don't have a problem, nobody has a problem with their focus, but their focus is we just want to make sure the money goes direct to the source. And so the branch discussion, they may not have an understanding about the fact that it's not one location, it's 3 locations, but all of them are providing housing counseling services. So it should be counted in the same way as if it was 3 independent agencies. They may not have that understanding.
And one of the complexities to this is that there are a number of our agencies that have multiple government contracts, and it's only this particular contract that is having the higher standard. And do you change your indirect cost rate for everything in order to do this one? I mean, I've actually heard about a couple of agencies and intermediaries who we're talking about maybe it's not worth being an intermediary anymore, given that it's an outlier.
I, in fact, said that very same thing to Sarah. I told her that, my concern is that the strongest agencies, the ones who, quite frankly, have the option to leave money on the table, may decide to do that. And I was not saying that as a threat. I was, I'm not speaking for Home Free USA. I'm just saying that there has to be a level of understanding that the more burdens you place on any agency to do a whole lot of compliance work and all of that, and then the returns aren't there for work they're legitimately doing, not only, and then it's a reimbursable grant. You've got some very strong agencies who could decide, this is just not worth it, and I don't want to do it. And then where are we going to be?
Absolutely. So we're not going to be able to get to everybody's comments. Melody, do you want to pick out a couple high-level things you're seeing that, or individual ones?
Sorry about that. The question we have here is, how does moving phone to indirect to indirect help with an existing NICRA. The rate was created based upon phone being a direct expense, not indirect.
Well, it used to be that, and let me give you guys a caveat and say I don't do our billing, so I'm sorry if I mess up a few words here and there. But one thing that I do know is I believe that HUD used to allow phone costs as a direct expense. It's now only an indirect. And so as a result of that, they could only charge but so much off to the grant. And that has a major impact for an agency who does primarily phone counseling.
So the short answer to that is yes, and it is a change, and that's one of the areas that people are just having so many problems with. And if it were consistent across all government contracting basis, then it would be more doable. But if it's an outlier, it becomes more complicated. Melody, what else?
This is more of a comment, but I'm sure it sort of captures what a lot of people are probably feeling. This is from Tamala Skipper. We continue to have struggles with our contract communications and payments. Also, we cannot get Mr. Danbury Carmen to respond to any communication. Our certificate has now been put into inactive status twice because of non-response. Escalated, but no response.
And one thing I would suggest here is to reach out to Phyllis Ford. So we have a hotline relationship that we established many years ago with when we had that large housing counseling wide meeting probably 4 years ago now, to deal with complaints and challenges, and also where there's a gap. And you might not feel comfortable about escalating issues, you can go to Phyllis Ford and tell her, and she will discreetly address those issues in a way that won't impact your program, but can escalate them pretty quickly. And just shoot me an email. If you don't have that contact information, I'd be glad to provide it. We definitely want people to use it. Probably haven't talked about it recently enough. But that's a critical issue as well. But thank you. And the other thing is, for people who have sent us comments, you should tell me whether you want your name and your agency attached to them, or if you'd rather have them submitted anonymously. I'd like to get these in next week as early as we can. And you know, if you want your name on, that'd be great. If not, maybe we'll just move forward with doing them anonymously. We don't want to make anybody uncomfortable on this side of the fence, but do want to provide as much raw data as we can. Melody,
but what also, Bruce, what it could be also is that people just give city and state, even if they don't give organization name. I think even that would be powerful in showing how far this reaches.
Sure.
Yeah.
Okay, good. So we're going to wind it down really quickly. Thanks so much, Simone, for all that good work, and let's continue talking about it. We've had a really good year last year in organizations joining NHRC. Really appreciate it. We're in renewal phase for a number of groups right now, but you know, this support and groups stepping up and joining means that we're able to do this kind of work, not be dependent on outside funding for doing the advocacy work that we do. We obviously get the discount on your credit reports, but really what you're doing is you're supporting this work. We've been able to expand, so we now we're a staff of 3. For a long time we were a staff of 2, so that's really great. And membership is a big piece of all that. So thanks so much for everybody. Now, next call in 2 weeks is going to be very interesting. It's going to be completely focused on advocacy and how are we going to be more effective in Congress to really turn around the funding situation we've got. It is an interesting idea that Simone has proposed, that we talk with Congress as well about the contracting process, and we would probably need to figure out 1 or 2 champions who might be helpful in that part of the conversation. You know, in general here, we want groups to feel comfortable and safe in doing the work that they do in advocating, in lobbying. It is legal for 501c3 organizations, and So we'll kind of do a broad and deep dive into all those issues, but also the idea is to make all of the organizations more effective and build a deeper, richer relationship with people in Congress. So pretty vital work. Look out for emails from Melody around the congressional work between now and then. There's a number of areas where we're trying to move proposals with particularly House and Senate members in THUD appropriations. And so thank you for all those that have jumped in, and there'll be plenty more coming. Okay, with that good note, thanks everybody for the good work you're doing, and we will talk in 2 weeks. Thanks, bye.